Assalamu alaikum. Today we'll discuss about investment performance measurement issue. In case of investment performance calculation and also presenting to clients, there is always a dilemma regarding how we can calculate the performance when there is external cash flow, because when there is external cash inflow and external cash outflow, it always complicates the performance measurement. For example, in case of open-end mutual fund, there is redemption, there is new unit creation. So in case of personal portfolio, you have complete discretion regarding when you can invest new money and when you can withdraw. Also, there are cases when you do not have any discretion as a portfolio manager. For example, you are managing a pension plan where regularly there are some contribution by the plan sponsor, and also there are benefits that need to be paid to the retirees. So in those cases, it often gets complicated how we should calculate the performance and how you disseminate that to the clients. And when there are some confusion, how we can deal with that. In this lesson, we will discuss about the two performance measurement method. One is the money weighted rate of return and another is the time weighted rate of return.
One of the biggest dilemmas and confusion in terms of calculating and showing in terms of performance measurement about how to deal with external cash flows. External cash flows are like new cash inflows and cash outflows in the portfolio. So question is how to deal with those external cash flows. So in this discussion, we'll discuss about how we can deal with those external cash flows. We'll also discuss about the money weighted and time weighted rate of return. We'll also see an example of money weighted and time weighted rate of return and what are the practical issues to deal with those things. So let's discuss about the money weighted rate of return. So in case of money weighted rate of return, it is nothing but the internal rate of return. So money weighted rate of return is the constant rate of return that would produce the total ending portfolio value given the magnitude and the timing of the cash flow. So remember, the timing of the cash flow and the magnitude of cash flow both are considered in case of money weighted and time weighted rate of return. So in case of money weighted rate of return, every time does not get the same weight. For example, if you invest in 2019 and 2020, both year does not get the same weight unless in both year your portfolio value is same. So if your 2019 portfolio is higher than 2020 portfolio, then 2019 gets higher weight compared to 2020. So money weighted rate of return gives greater weights to time periods when portfolio value is greater. So when external cash flow comes in, your portfolio increases in value due to new injection of the fund, and in that period, portfolio gets a greater weight. That time gets greater weight, and when there is a redemption in the portfolio, your portfolio value shrunk and your weight in that year reduces. So money weighted rate of return is affected by the external cash flows, and the rate of return is being significantly influenced by the frequency and the magnitude of the cash flow. So let's talk about the time weighted rate of return. Time weighted rate of return consider a buy and hold strategy. It reduces, it calculates the rate of return that you would earn. It is the compound rate of growth of $1 initially invested, and you hold the portfolio over time. So time weighted rate of return is not affected by the external cash flow. So whether money injected or whether money is liquidated, it doesn't matter, because time weighted rate of return always removes the effects of external cash flows. It's always calculated if you invested $1 today and hold your investment throughout the period when we are measuring the performance. So let's see an example. Assume that you are a portfolio manager and you have a single client. So your client invested 5 million with you at the beginning of 2019. So you have generated 30% holding period rate of return in the 2019 year. So your portfolio value went from 5 million to 6.5 million. So your client becomes extremely happy. So your client gave you another 8.5 million taka at the beginning of year 2020. So at the beginning of year 2020, your total portfolio value is 15. In that year, unfortunately, you lost 20%. So your 15 million portfolio went to 12 million at the end of 2020. So now your client want to withdraw the money. He want to see the performance of the portfolio, how you have achieved in terms of performance. So you decided to calculate the time weighted rate of return. So in the first year, you have generated 30% rate of return, and in the second year, you lost 20%. So if we average out the 2 years rate of return, your total compound annual growth rate will be 1.98%, which is roughly 2%. So you have told your clients that I have achieved 2% positive rate of return. After getting that performance, your client became extremely angry. He said you that I have given you 5 million at the beginning of 2019, and then I've given you another 8.5. So my total deposit is 13.5. So the account balance is showing 13.5 deposit. At the end of the year 2020, you can see 12 million. So I lost 1.5 million. So are you kidding? I've lost 1.5 million, and you're saying that you achieved 2% positive rate of return. How you have come up with that calculation? It must be wrong. So the answer is that you are calculating based on assuming that you have invested $1 at the beginning of 2019, and you kept that $1. You haven't invested more, or you haven't withdrawn any money in the portfolio. In that case, you would get 2% annual rate of return. But your client had invested 8.5 million taka at the beginning of 2020, and in that year you lost 20% rate of return. So at the beginning of 2020, your portfolio value was 15. At the beginning of 2019, your portfolio value was only 5. Year 2019 gets lower weight, and year 2020 gets higher weight in case of money weighted rate of return. That's why, since you lost money, your money weighted rate of return must be negative. So if you calculate the internal rate of return of the cash flows, where in year 0 you have invested 5 million, year 1 you have invested another 8.5 million, and year 2 you are getting 12 million, then if you calculate the internal rate of return, your internal rate of return will be negative 8.3%. So your client is referring that I lost money, so my rate of return must be negative. You are calculating time weighted rate of return, which is positive in this case. Question is how to deal with that scenario. Question is when to use time weighted rate of return versus when to use money weighted rate of return. So let's talk about some of the practical issues when time weighted rate of return should be used and when money weighted rate of return should be used. So assuming you are a portfolio manager and you do not have any control over the money injection and over the money redemption, for example, in case of opening mutual fund. So in that case, your external cash flows are unrelated to the management of the portfolio because you do not have any control. In that case, time weighted rate of return is the appropriate rate of return. So there is a need to neutralize the impact of external cash flow. So if you want to neutralize the impact of external cash flows, time weighted rate of return should be used because you as a portfolio manager do not have any control in terms of timing of the cash flow at that point of time. So if you want to distinguish your growth in portfolio from growth in the value due to external cash flows, then you definitely have to calculate time weighted rate of return so that you can negate the effect, you can remove the effects of external cash flows. But when you want to calculate the time weighted rate of return, each time when there is a cash inflow or cash outflow, you need to know the portfolio value of the portfolio amount, because if year 2019 you invested 5 million, 2020 at the beginning of 2020 you have invested another 8.5, but you had 6.5 million because your 5 million grew to 6.5. So your total amount of portfolio was 15. So you need to know whenever there is a cash injected or whenever there is a cash outflow, you need to know the portfolio value at that point of time. So there is a need for accounting of a portfolio. You need to record portfolio value every time there is a cash inflow and there is a cash outflow. Another practical issue is when money weighted rate of return is appropriate. So the money weighted rate of return is appropriate when the accurate valuation is required, how much money you have invested and how much you got. And also it is extremely important for asset classes that do not have right measurement of the value. For example, in case of asset classes, for example, bond or stock, there is appropriate measurement of the value of the stock because stocks are quoted it is being traded every day. Bonds are quoted, it is being traded every day. So when there is a public market exists, then it is easy to calculate the value of your asset. But in case of a liquid asset, you do not know the right amount of value. So in case of a liquid asset, you often rely on appraised value, and appraisal based valuation often differ. So if you need to know the accurate valuation, especially in case of a liquid asset, then you need to calculate the money weighted rate of return. That's why you will see that in case of private equity investment, IRR is being used rather than time weighted rate of return. Money weighted rate of return is the appropriate rate of return when the manager is responsible for timing of the cash flows. You have complete discretion on the timing of the cash flows. Then money weighted rate of return is the appropriate portfolio. For example, in case of your personal portfolio, you have the absolute discretion about when you can invest money and when you can withdraw. Also, money weighted rate of return can be appropriate rate of return for firms with fixed termination date, where early distribution of the capital might be useful. It might improve the IRR. In that case, you might have, if you have complete discretion of liquidating fund early, then money weighted rate of return can be appropriate. So in this lesson, we discuss about money weighted rate of return and time weighted rate of return. When money weighted rate of return outperform the time weighted rate of return, when you have invested more money, your money weight is higher, and in that period, you have achieved positive investment performance. If in the period when your portfolio value is higher and you achieved a negative rate of return, then money weighted rate of return underperform time weighted rate of return. We have also seen an example with a practical scenario where how to deal with money weighted rate of return versus time weighted rate of return, and how you can communicate the differences between the money weighted rate of return and time weighted rate of return to your clients. Thank you. If you have any questions, you can feel free to comment. And also, if you want to know any topics, please let us know. We would like to answer most of the topics. Thank you.